Bloomberg Audio Studios. Podcasts, radio, news. This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, two extra special guests, Alex Imas and Richard Thaler, took Richard's book, The Winner's Curse, and really completely rewrote it and updated it for 2025. I've been privileged to speak with Dr. Thaler a number of times over the past few years. He's been a guest both here and live in Chicago a number of times. Always a fascinating conversation. And Alex Imas is this really interesting professor who I had no idea I have used and relied on his previous research. Selling Fast and Buying Slow is a chapter in my book. Just an amazing coincidence. Both fascinating people, and I thought this conversation was a lot of fun, and I think you will also. With no further ado, Alex Imas and Richard Thaler on The Winner's Curse.
Thanks, Barry. Great to be back.
Yes, it's so great to have you. So you wrote this book, it's 30 years ago already. We're going to get to this in a bit. Before we do, I want to just talk about both of your backgrounds and how you began collaborating. Richard, you've been called the godfather of behavioral economics. Take us back to the beginning when you were a young economist. How did you become interested in psychology and decision making?
So when I was in grad school and I was learning standard economics, I kept pausing and saying, really? Because the models that we were being taught, there are no people, and there are agents, and there are firms, and there are things they call consumers, but they're not really people.
Homo economicus.
Homo economicus. And I started making a list of dumb stuff people do. But that was just to annoy my friends. But then somebody introduced me to the work of two Israeli psychologists, Danny Kahneman and Amos Tversky. And when I read their papers, I had this big aha moment, because what their research showed was not just that people make mistakes. Of course, we all make mistakes and can't remember where we left our keys or what have you. What they showed was that behavior is predictably different from the model that economists use. And that was an aha moment for me, because it meant I could say, look, the model is wrong and in this direction. And you can think about that from an investment point of view. Mm-hmm. It's fine to say stock prices are wrong. That's fine, but useless. If you can say which ones are too high and which ones are too low, then all of a sudden you're a very rich man. So if we could say how people are different than this artificial model, then we could be in business. And then, so I was doing that for a while, managed to get tenure at Cornell University, and spent a year with Kahneman and Tversky, and then a second sabbatic year with Kahneman. And in 1985, the year Alex was born, I came back from sabbatical and decided to start writing a series of columns in a new economics journal called the Journal of Economic Perspectives. That journal, by the way, here's a free tip. That journal is available free to anyone, and the articles are written to be understandable. Mm-hmm. And people don't know about it. If you're really interested in economics, Go and read some papers.
And the column you were writing was called Anomalies, which were all of these things that were supposed to not be possible given traditional economic theory. You mentioned Kahneman and Tversky. When you think of psychologists, you don't think of quantitative, data-driven, rigorous models, but really that was at the heart of what they were doing, wasn't it?
Well, eventually, their earlier work, you're thinking of prospect theory, which was 1979. The work they did in the 70s leading up to that was on predictions or judgments. And the models weren't very quantitative. They were typically a little scenario and almost like a thought experiment. You know, there's a famous experiment about Linda. And they give you a description of Linda. She was an undergraduate, active in social movements, went to lots of demonstrations, blah, blah, blah. She's now you get a list of occupations. And you're asked to say, which is most likely. And one of the ones is bank teller. And another one is feminist bank teller. And people think she's more likely to be a feminist bank teller than a bank teller. Now, obviously, that cannot be true. I shouldn't say obviously, because many people are now listening and saying, what does he mean obviously? Obviously, she's a feminist bank teller. She couldn't just be a bank teller. But that's,
through the number theory, there are going to be more bank tellers than feminist bank tellers.
Think of a Venn diagram, right? There's a big circle of bank tellers, and then a small one with feminist bank tellers. So that was the kind of things they were doing. There was a little bit of theory. So like they had, the idea was that life is hard, and so people used what they called heuristics, rules of thumb, to make judgments. One is called the availability heuristic, which is if it's easier to think of examples of something, it's more likely. So if you ask people, what's the ratio of homicides to suicides? People think maybe 2 or 3 to 1, that homicides are more likely. It's just the opposite.
Even money?
No. Twice as many suicides. Think about this before you buy a gun.
Right.
The most likely person to get killed with that gun is a family member. So, but again, notice this is a predictable mistake. And because, why? Well, there's lots of stories in the newspaper about homicides. Suicides tend to be quieter.
There's a wonderful graphic from Our World in Data, which was Hans Rosling's work that shows here's how things are reported in the media, and then here's their actual percentage in real life. Very little reporting on cancer, heart disease, high blood pressure, diabetes. You're 50,000 times more likely to suffer from that than homicide, terrorism, or shark attacks, which they love to.
Right, shark attacks. Don't worry about those so much.
Unless you're in Australia,
especially in Chicago, it's probably not a big.
Yeah, there are very few.
So let's bring Alex in. So when Richard started out in the field, there really wasn't any such thing as behavioral economics. You have an advantage a few decades later of entering the field of behavior, of economics, where behavioral economics is a thing. Tell us a little bit about what brought you into the field and how you found your way over to Booth.
Well, so behavioral economics was a thing out in the economics journals, and there were people certainly doing it in various departments, but it wasn't a thing as an undergrad. Like, I don't think there was a single behavioral economics course offered at Northwestern University and this was 2003 through 2007. So even though, people were publishing behavioral economics papers, it was all over the journals. People generally in the field knew about it. As an undergraduate, it still had not made it into the curriculum.
03 to 07 Danny was 2002 won the Nobel, is that right?
Still no
So you would have
classes.
thought someone might have picked up on that, and yet
No, I mean,
and
you
Northwestern is a big school.
You open up a microeconomics textbook, it's the same textbook from 1973, basically.
And that's still true today.
It's still
Come
true
on,
today.
really?
Yeah.
I would have assumed at this point,
No, open up a textbook.
Danny Kahneman, Bob Schiller, Richard Thaler. How many Nobels have to come in this space before?
Starts with perfect competition. Then at the end, maybe you learn something about monopolies, and that's pretty much it. So it's I was pre-med. I'm an immigrant kid from Moldova, so my parents are like, well, you're going to the medical school or you're going to fail, basically. So I had one option on the table. So I was pre-med. Organic chemistry was real hard, and it was 8 o'clock in the morning.
Right.
So I took econ to kind of just boost my GPA. I thought it was kind of fun.
Right.
And, and it was interesting because I was taking these psychiatry, abnormal psychology classes, learning about human behavior. I was taking economics, which is the study of human behavior. And these were like two completely different worlds, right? Economics is these hyper-rational, utility maximizers, had never made any systematic mistakes. And I didn't learn about a single deviation from that principle in the entire 4 years I was there. And so I was thinking this is kind of, this is fun, but not something I wanted to do. I'm interested in human beings. And then afterwards, I was applying to medical school, and I was doing a cross-country road trip with one of my friends to Los Angeles. And we were listening to, I think it was NPR, and it turned out, ex post, I figured this out, Richard was on the radio
Right.
talking about something called behavioral economics. And I was like, what is this? And as soon as I got to Los Angeles, I went on the internet and I was like, I got to find out more about this field. So within 2 weeks, I had, talked to my advisors at Northwestern. I want to get an econ PhD. If I can do something like this where I can combine my interest in economics and bring in human behavior into it, this is what I wanted to do.
So let's talk about that. There's something in the book, and we'll get to that shortly, where you describe an economist developing a new model, a new calculation for how consumers should behave in response to certain price incentives. So the first time ever, someone creates this calculation, and then immediately afterwards, and therefore this is how all consumers are or should be behaving, when nobody had thought of this previously. How do you square that circle? How do you square the model-driven, this is the right way to do it, I just figured this out, and therefore everybody should be doing it this way?
Yeah, maybe just a tiny bit of history will get us there. So economics didn't used to be that extreme. If you go back and read Adam Smith, he talks about self-control problems and overconfidence. And people think of him as the father of right-wing economics. That's not the guy. He did talk about the invisible hand, but he was a behavioral economist at heart. And economists were pretty reasonable until about World War II. And then what happened was people started writing math, doing math, and they wanted to write down models. And if you want to write down a model, the easiest one to write down is a rational model. And that's because anybody, if you've taken high school calculus, you can maximize, you set the first derivative equal to 0, and that's the model, right? So writing down a model of some ish is hard. Then during the 70s and 80s, people started to get ideas for even smarter behavior. And a norm kind of developed in economics, which is if the agents in my model are smarter than the agents in your model, then my model's better than your model. And that's kind of crazy. But that was the way the field was going. And there was no real stopping it. So around the time that Alex was thinking about going to grad school, there were troublemakers like me pointing at certain body parts of this naked emperor, but the field was rushing toward an extreme version of Homo economicus, where Homo economicus is a genius.
So we were talking a little earlier about the so-called wealth effect, which is something that the economists at the Federal Reserve love. The higher the market goes, the wealthier people supposedly feel, and they all go out and spend money. That's like just such a perfect example of a model that doesn't reflect the real world. A huge amount of stocks are owned by the top 10%. It's something like 52% of stocks. The average person doesn't really have a whole lot at stake in the market. And the reality is people are spending more money because the economy is doing well. They have jobs, they're getting raises, which, by the way, all helps the market. How often do we run into these correlation, causation issues in economics?
Well, we run into them all the time. Look, the big problem with that, with the wealth effect, there's a lot of discussion of that in this book. One thing economists leave out is what I call mental accounting. Mm-hmm. And if you look at an economic model of the wealth effect, there's some big W for wealth, and that's it. And wealth will include your house and your retirement money and money you've set aside for your kids' education, and then money that you intend to give to charity.
And your future expectation of all of the money that you stand to learn.
Right. So now the people at the Fed, if they're just saying, well, W goes up, then people spend more. No. It turns out, for example, if the value of your house goes up, how much more do you spend? Approximately zero.
Really?
Approximately zero. Whereas if some stock you own gets bought and you get a check, you spend a lot of that. Mm-hmm. If you win a lottery, you spend like half of it.
And go bankrupt.
So where the money sits has a big effect on how much of it you spend.
Your response to somebody's question, how are you going to spend the windfall from the Nobel Prize, was one of my favorite answers. You said, do you recall?
Yeah, well, I recall. I mean, this was at 4 a.m. They call you and wake you up and then say, go get some coffee because you have a press conference in half an hour. And I had heard enough of these interviews to know that somebody was likely to ask me that question. And my instinct was to say, well, you know, to a real economist, this is a stupid question, because how am I going to know? You know, suppose I go out and buy some fancy new car. Barry likes fancy cars. I don't. I like fancy wine. So suppose I go and buy a case of fancy wine. How do I know that's the Nobel money, as opposed to the money I got from selling a book?
All dollars are fungible.
All dollars are fungible. And you know, I realized later that what I should have done is opened up a special account.
The Nobel Prize money.
The Nobel Prize money. And a credit card that's linked to that. And when I want to go buy something stupid, just take out the Nobel card. And life would be more fun.
But the line that you said was, as irrationally as I can.
Yeah, I said I'll just spend it as irrationally as possible. I knew it would be a memorable line.
So it's so funny because that line led to a conversation with my CFO about the difference in all of these, the Chase Sapphire card or the Amex Platinum card, where you get these points. And the rational CFO says, hey, I want the money back each month. And my response is always, it's $100, $200. It's lost in your bank account. You don't see it. When I get the points and want to buy a fancy cappuccino maker that my wife is going to yell at me, why are you spending $2,000 on a cappuccino maker, you idiot? My answer is, oh no, it's points. It's free. And she's like, okay, go get it. It's the exact same concept. If you have that silo, that mental accounting, you could do as much irrationality as you'd like.
So, but watch out if she listens to this podcast.
She listens to the first 5 minutes and that's it.
Oh, yeah. So you're safe.
I'm okay.
So I'll tell you a story about my daughter Maggie, who lives in Rhode Island, and one of her neighbors grew up to be a pitcher for the Mets. Mm-hmm. And the Mets were playing in the playoffs, in the first round.
So this is a long time ago.
Yeah. And this is an old story. And this guy was going to pitch. So I call Maggie, hey, would you guys want to go to the game? Let me see if I can get tickets. And she says, oh, that'd be great. So I go online. The game is like tomorrow. And I find some tickets. And there were a bunch, on StubHub or something. Mm-hmm. You could get tickets. So I text her back and said, look, here's the website. It looks like there are lots of tickets to choose from. How about the tickets were about $300? I said, how about I'll send you $1,000, buy the tickets you want, spend the rest on hot dogs.
So you're doing an experiment on your daughter to see if she buys the cheap tickets or the expensive tickets.
So she texts me back and says, LOL, this is just like in your book. If you send me $1,000, I'm not going to use it on baseball tickets. So I've learned my lesson. Recently, she wanted to go to a concert. David Byrne is on tour. And he was in Providence, where she lives, and she wanted to go. And she says, there's some way you could get me tickets. I sent her the tickets.
Instead of the money. That's so funny. Let's talk a little bit about the book, The Winner's Curse. And I want to start with Alex. So this book has been out since you were a young kid. Mm-hmm. You go to college. You eventually figure, let me get a PhD in behavioral economics or finance and economics. How did you first discover this book? What was your initial response to it?
So I discovered it. There's not really any textbooks in behavioral economics. So you kind of get here through the grapevine, oh, you should read this, you should read that. You mostly read journal articles. Mm-hmm. Like if you're thinking about doing game theory or something like that, there's like 5 or 6 textbooks that you can read. With behavioral economics, there's not a whole bunch. Winner's Curse was one of those books that almost everybody recommends because the anomalies columns are just very, very accessible. And then you read the anomalies columns, they got a bunch of references, you look through the references. So I had read the original Winner's Curse, I think, second or third year of grad school. And then I got my first job at Carnegie Mellon. I had already known Richard for a while at that point. We met in graduate school. His office happened to be right next to mine in San Diego. And at some point I joined Booth. And he called me up, I think like 4 or 5 months into my first year and said, hey, I got this opportunity. The publisher asked us to update the book. I'm thinking of doing a little bit more than just an update. The book's from 1992. There's been 30 years of research. Are you interested in working together on this? So I jumped on the opportunity. One, I get to work with Richard, which is super fun. But two, I've been doing behavioral economics research for a while. And I know how much demand there is for a book that people can pick up and read and say, hey, these are the original anomalies. Here's the 30 years of research that has happened since. Now, I think at that point, we were thinking 6 months, do a little update. This was 2020. This conversation happened in 2020. The book is coming out now. Basically, the 2/3 of the book ended up being brand new. We rewrote slightly each anomalies column as kind of the bedrock. But, 30 years of research has happened since, and it took a while to put all of that together. And essentially what we showed is, look, the original anomalies, when you read them, most of the experiments, most of the findings are from, college students, sometimes, after a bad night out in the lab for, making decisions over $1. And the big kind of pushback from economists was, look, we don't really care about these people. We care about, institutional investors, CEOs. We care about people who are in the market with money on the line, making all these big decisions. And so why has behavioral economics become a success? Honestly, largely because of behavioral finance. Because of the fact that behavioral economists said, look, we got access to this amazing data on people making consequential decisions day in and day out, and they're still making mistakes.
Coming up, we continue our conversation with Richard Thaler and Alex Imas, discussing the book they have recently updated, The Winner's Curse, Behavioral Economics Anomalies, Then and Now. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guests this week are Richard Thaler and Alex Imas, both of the Chicago Booth School of Business at the University of Chicago. I love what Danny Kahneman once said is, I suffer from all the same behavioral biases that I've identified. You mean to tell me that we have 30 years of data, all this research, a handful of books, people still make the exact same behavioral mistakes they used to? Has there been any change in behavior?
Essentially, no. And that's not that surprising, because the stuff we're talking about has been true as long as there have been humans, right? So we talk about self-control problems. It's in the Bible, right? Homer talks about Odysseus tying himself to the mast. That's like agreeing to have money taken out of your paycheck and put into a retirement plan. So human beings, yes, there's evolution, but evolution takes thousands of years. And 30 years is the blink of an eye.
Since you mentioned retirement accounts, let's talk a little bit about choice architecture and nudge. Before I arrived here, I looked up what was the impact of the default setting that you helped change through choice architecture. People used to get a new job, sign up for a 401k, and the money would come into that account and it would sit there in cash. And rather than have the default be cash, we, through your work, created a default as a either a target date fund or a balance fund, something like that, so it's not sitting in cash. And it turns out there's about $4.7 trillion with a T, trillion dollars in those funds, of which 40%, according to recent research, was the default setting. So you get credit for about $2 trillion in retirement savings that might have otherwise just been sitting around in cash. How does the concept of people aren't learning from their mistakes, so choice architecture is so important to help people make better decisions, how significant is that?
Well, if you think about what was going on in the early 80s, these defined contribution plans like 401ks were real new. Our parents, if you worked at a big firm, you had a defined benefit plan. My father worked for Prudential Insurance, and his pension was number of years worked times some function of his final salary. No decisions to make, kind of like Social Security. And we bring in these defined contribution plans. You have to decide whether to join, and if so, how much to defer, and then how to invest it. And people had no clue. And a lot of people just didn't even join, which is about the dumbest mistake you can ever make.
If you have a company with a match, you're basically turning down free money.
Right.
Which, what economic model says that's rational?
No, well, right. So I would say to economists, look, you would predict no one would make this mistake, but one early study, half the employees at a company are not joining in the first year.
It's amazing.
So how do we fix that? Well, the simplest thing was to change the default. So we say, it used to be you'd get a form to fill out, a piece of paper in those days. And if you want to be in the plan, fill out this form and say you want to join and how to invest. Change that to you welcome to Ritholtz Management. We have a pension plan. We're going to enroll you unless you opt out. And we're going to enroll you into the default fund unless you choose otherwise. So all of that was not possible in the early 90s because companies were afraid to do automatic enrollment because they didn't have permission, and target date funds weren't legal. Ironically, in the George W. Bush administration, on one side, they were campaigning to partially privatize Social Security, but their Labor Department was forbidding companies from investing in anything that could go down. Mm-hmm. So there was a bill passed in 2006 that said, okay, you're allowed to automatically enroll and have and automatically escalate, what we used to call Save More Tomorrow, and invest in some prudent funds. And what you have to give something up to get that. So what I suggested there was a Republican senator from Utah who was running the relevant committee. I said, how about if companies agree to do all three of those, they're exempt from some burdensome paperwork of non-discrimination rules. Mm-hmm. And so that's what the Republicans got, was less paperwork, and people who cared about the workers got something, and
the workers got something.
And the workers got something. And if they just do nothing, then they're in, and their contributions are going up, and they're in a sensible investment product.
So this is nudge is kind of fascinating because in the Winner's Curse, you talk about things very much related to what happens in investing. So there's loss aversion and the status quo bias and a variety of different things. Let's talk about what are the issues that most relate to, as Alex said, behavioral finance as opposed to behavioral economics. What do we think are the biggest factors that explain irrational human behavior in stock and bond markets?
So I think there's a few things that kind of people documented in the late 90s, early 2000s that have just replicated and just became bigger, if anything. So the disposition effect is one of them. So the disposition effect, this is Sheffrin and Statman. They came up with a paper in 1985 documenting it originally. Terry O'Dean has this giant data set that he published in 1999 documenting it in a bit of a larger sample. And then now it's been replicated in Finland, all over the world. And it's this tendency for people, when I buy a stock, it goes up in price. What do? I sell it. I want to realize my gains. Same stock goes down in price. This is now a loss. What do? Hold on to it. So it's this tendency to realize your gains and hold on to your losses.
Peter Lynch, by the way, 40 years ago used to call that cutting your flowers and watering your weeds. That was his expression for it. So it was visible to a guy running a fund at Fidelity in the 1980s.
Yes, and this is just talking about are people learning? I mean, apparently not, because it's again, I bet you download Robinhood data from today, you're going to see it show up. So that's and this is kind of the tendency. What feels good when you own a stock? selling it at a gain and, telling your friends, hey, I bought that thing for 90, it's 120, I just made a lot of money. You know what feels worse telling your friends? I bought it at 90 and I sold it at 60. So you just kind of hold on to it, hoping something happens. Maybe some people even double up, buy more shares just to break even. So the disposition effect, this kind of tendency for individual behavior to realize gains, avoid losses. The other thing is, in my view, this is kind of the bigger principle is limited attention. So, there's a lot of stocks out there. Which ones are people buying? And this is not just retail investors. This is bigger institutional investors too. It's the ones that are covered in the news. We were talking about availability bias earlier. What are the things that are coming to mind? Things that have recently been covered. Maybe you heard an earnings announcement call or something like that. These attention-grabbing stocks that are much more likely to go into people's portfolios. It's because people aren't evaluating the entire universe of stocks whenever they're thinking about something to buy.
So let's address that, because the United States happens of all countries not only has such a large stock market, but the home country bias is so acute here. And you don't hear a lot about foreign companies all that often. You mostly hear about local companies, local CEOs, local products. How significant is that sort of bias in people's portfolios being not only overloaded with their own country, but hey, if you're in New York, you can have more finance companies. If you're in San Francisco, you have more tech companies. If you're in the Midwest, you can have more manufacturing companies.
It's more extreme than that. If I'm working for a specific company, I have more of that stock.
When, if anything, you should have
be
less.
diversified.
Right.
Yeah. I think one campaign that has been moderately successful is, I think fewer companies are foisting stock of their own company onto the workers. It used to be the match was often paid in company stock.
Well, GE was notorious, and they lost $500 billion of employee investments because of their match.
Well, and Enron.
So
zero.
one of my friends, their father, he was working at Enron. He was a risk manager. FYI.
Oops. Not a very good one.
huge percentage
Although you could be the
Enron.
greatest risk manager there, the bosses were not listening to you.
Right, but they compounded it by putting their employees' money in the 401k into Enron stock.
Yeah.
So they get fired and their retirement money goes poof.
Right. Unbelievable.
But, looking back at what people were owning, I mean, there is that, people in the 401k element, but people who were working there were freely buying Enron stock, right? According to economic models, you should be diversifying. You already have a bunch of Enron stock in your 401k. You shouldn't be taking your discretionary spending and buying more Enron stock. And that's exactly what was happening.
This home bias applies all around the world. At least the U.S. is a big country. I wrote a paper once about the Swedish social sort of 401k plan. This was a risky move because I was making fun of it, and there was some award that might happen. But anyway, Sweden is 1% of world GDP.
Tiny GDP, tiny.
And they
stock
were
market.
putting most of their money in Swedish stocks. It's crazy.
They ignored the other 99% of the world.
Yeah.
But that just goes to show you the bias. So the obvious question is, if you two were advising a portfolio manager, what sort of behavioral principles would you emphasize for them to build a robust portfolio?
Well, as you know, one hat I have is I'm involved in a company that does this.
That also has your name on the door.
It also has my name on the door, Fuller and Thaler Asset Management. And now let me say, I cannot name a single stock we own. And no one at the firm would think it's a good idea for me to be making suggestions. We're buy small cap stocks. So it's, if we owned Apple or Tesla, I might know it, but we don't buy any big stocks. So they're mostly companies you've never heard of, and I've never heard of them.
But this is because you've identified a behavioral issue that is now reflected in the model that they use to purchase.
Right. So we're not a quant shop, which is a little unusual for a firm that's run by some academics. But each strategy is based on a bias. So there's one that's based on overreaction. There's one that's based on underreaction. So we try to find stocks that we think the rest of the market is making a mistake about. And then we forbid the portfolio managers from forecasting earnings because that they're going to be, do we think with our 30 employees that we're going to make better forecasts than Fidelity? It's crazy. But we think we have an advantage because we're trying to predict something else. We're trying to predict the mistakes. It's like you're a baseball fan. If there's a pitcher that is a sinker ball pitcher, Alex, this means the ball goes down as it approaches the plate. These foreigners. But, if there's a sinker ball pitcher, you and I can predict batters are going to hit ground balls because they are fooled. The ball drops, and if you hit it slightly above the center, the ball goes down. So you don't have to be able to hit a ball to know it's going to go down. And so we don't have to be able to forecast earnings to predict that other people are going to be predicting too high.
I want to bring this back to the book because one of the concepts underlying the book was, hey, there's a reproducibility issue in social sciences. How well have these anomalies and the theories you built around them, how well has this held up? How robust and reproducible are these findings? And it turns out, talk to us about what you guys discovered when you were revisiting all of these principles that were first written about 20, 30 years ago. Yeah,
so as you mentioned, there's a some might call a crisis of reproducibility in social science more broadly. So this is psychology, some sociology, et cetera. And the worry is that, these anomalies that were published in the 80s and 90s, these are the bedrock of the entire field of behavioral economics. And you might be worried, like, look, maybe these things don't reproduce. And there's two ways that they don't reproduce. One, you run the same experiment again and it doesn't work. It was p-hacked. As I said, like small sample sizes, no incentives. The second way it might not reproduce is that it literally only reproduces in the exact conditions it was run originally, with college students at low stakes. You go out in a different population with people who are a bit more sophisticated, know what's going on, and it doesn't work. So what we did in the book was to say, look, first, let's take the exact same experiments and run them again. Everybody knows about, the original anomaly, so maybe they don't work because people are like, this is a loss aversion experiment. I know what's going on. I'm not going to do this. This is the endowment effect. I'm not going to do this. So we just replicated them directly on a completely different platform. So we used an online crowdsourcing platform called Prolific. Basically everything works. Everything works. And we, you don't have to take our word for it. If you go on the website of the book, we posted all of the results of our replications, but also instructions on how you can do it yourself. So if somebody's like, I don't know about these guys, run them yourself. And, people are still loss averse. They still have the endowment effect. Things like the conjunction fallacy, the Linda problem that Richard was talking about, all work still. The second part is this external validity part. Does anybody other than college students display these effects? And that's kind of the updates part of the book. And the answer is yes. The loss aversion has been, and the myopic loss aversion part that's been used to explain the equity premium puzzle, that's still reproducible. We also do a bunch of out-of-sample tests of the anomalies that didn't use experimental data, and that replicates out of sample too. So people aren't learning. The psychology is the same.
One of the columns was about the equity premium puzzle. We didn't include this in the book because it's a little wonky, but The equity premium is just the difference in returns between stocks and bonds. The equity premium puzzle is how big it is. And theory says it should be like less than 1%. And historically, it was about 7%.
Wow.
And the article about that was in the early 80s. So we've had 40 years of data since the puzzle was announced. The equity premium, exactly the same. It's maybe 1% lower. So, and that's what we see basically everywhere. Everything's the same.
So one of the concepts that people have challenged as not being very reproducible has been the concept of priming. To sometimes anchoring is similar, but that seems to be more reproducible. But when I hear Linda the bank teller story, that feels like the framing of that is very much a priming. When you hear about her as politically active and being involved in, how do you distinguish when you have these theoretical overlapping biases that all kind of interact with each other?
So priming is actually a huge literature in cognitive psychology. Basic priming is very robust. So it's the idea of, I say a bunch of words that start with a K. What comes to mind? A word that starts with a K. That's going to reproduce any day of the week. There's a special subset of priming research that was done kind of in the 90s, early 2000s that kind of took this to an extreme, which is, so here's an example. Let's say you're doing word search and there's a bunch of words that have to do with like oranges, palm trees, hot weather, like vaguely related with Florida, right? And then that's supposed to prime in your brain old people. And the result, the dependent variable, was that those subjects who had those words, they walked a little slower out of the lab, right? I mean, it's a little crazy.
Right. Kind of tough to measure also.
Yeah. So, I mean, there's a lot of degrees of freedom. The researcher can be looking in a certain direction, and those tend to not reproduce. The sort of priming that something like the Linda problem, for example, has. That's more in the kind of cognitive psychology wheelhouse of like, what do you think about when I describe a person who takes part in radical rallies? What comes to mind? This is a basic concept in memory, right? So the second part that I wanted to say is that priming, as far as like looking at the behavioral economics research, priming is a really small part. It was actually not really featured much in the book. But the type that was used by Tversky and Kahneman, it's much more in the wheelhouse of just basic cognitive psychology.
More like anchoring. Does anchoring still hold up?
Oh yeah,
very well.
Yeah.
Oh yeah,
yeah. And look, one of the things when I was writing those columns, I could pick anything. I picked big effect sizes. And some of the we talked earlier about the norm in economics to make models smarter and smarter. I think there was a norm in psychology for results to get cleverer and cleverer.
Well, I thought Alex's paper where you randomly sell versus what was actually sold, that was a very clever setup for a paper.
It was clever, but it wasn't what I was deriding is a norm that the models assume people are being clever, as opposed to designing a clever paper.
Gotcha.
We're all for clever papers.
Okay.
We like clever papers. So when I was choosing what columns to write about, I picked big stuff. And think about, there's a well-known company that makes cinnamon buns. And has the strategy of pumping the smell of that out into the airport. Now, let's say you're on a low-carb diet, just hypothetically.
Hypothetically.
If you walk by that thing, that's priming, and that works. And it's not
clever.
It just works. Right. It's a big effect size.
Yeah.
So so everything I wrote about was big. And it's because I wanted to pick things that I thought were well established. And so, I think if I had looked for cute little things, then some of them would have failed to replicate.
You also pick things that people were actively attacking and adversarially trying to replicate at the time that you were writing it.
Yeah, I mean, look, take the ultimatum game.
Okay.
Right? That's one of the original columns and one that we include in the book. The game is very simple. I give Barry $100. I say, share it with Alex. You can give whatever proportion of the 100 you want to Alex. He says yes or no. If he says yes, he gets whatever you offered and you get the rest. If he says no, you both get nothing. Now, the standard economic model at the time predicts that Alex will accept anything because something is better than nothing. Barry knows that Alex will accept anything, and so he offers him $1, and Alex accepts. Now, real people, only an economist would think that that's a really good prediction. Anybody who's not an economist is going to say, what are you kidding? I'm not going to take $1 and give you 99. You didn't do anything to deserve that 99. So if you run that experiment, if you offer less than 20%, you're going to get rejected. And the profit maximizing offer is about 40%. And most people offer half. Mm-hmm. Okay? Now, there were big fights. There was a professor from Brit who was saying this was challenging game theory. And no, it wasn't challenging game theory. It was challenging the idea that the agents only care about money and don't care about being treated fairly.
So let's address that, because I love the evolutionary biology of this. Humans were cooperative social primates. We have neither fangs nor claws, so we had to come up with some way to stay alive. And it turns out cooperating in a tribe is very useful survival tactic. It seems that an inherent sense of fairness is somewhat built into all of us, as well as social status seeking. So how much of this issue in economics derives from not understanding a little bit of evolutionary history?
You know, it's a tricky thing. Obviously, we have evolved to be who we are. There are some people who then say, well, that means whatever we do is optimal.
Well, maybe not.
No, that's stupid. I mean, we evolved on the savannah.
Right.
Right?
Nothing about picking muni bonds from a large assortment.
Right. You know, Amos Tversky was famous for one-liners. And he had a one-liner about loss aversion, which was, there may have been species that did not exhibit loss aversion, and they're now extinct. Right? So if you're at subsistence, it's really smart to be worried about losing.
It's an existential threat.
Right? But, you know, the three of us, we could go several days without eating, some more days than others.
Right.
Right? So we're not at subsistence. And yeah, managing our own portfolios is something people have been doing for 30 years. Right? Yeah, the rich people, but they had their broker do it, right? So there's no evolutionary history of how to manage a portfolio. And even saving for retirement, people didn't live long enough to worry about that. And if you were unlucky enough to reach my age, then you hoped your kids would take care of you, and they lived nearby. You know, then people started scattering and penicillin, and, you know, So now we live long, and our kids are scattered, and they have no interest in having us move in with them. So people had to learn a very new thing, and they needed some help.
Really, really fascinating. So we didn't talk about from whence the title of The Winner's Curse comes from. Why don't, before we get to the future of behavioral finance, let's talk about The Winner's Curse. Tell us where the name comes from.
The concept, I should say, the title of the book comes from the title of one of the chapters. And I picked it as the title back then because it's sort of a fun phrase and a bit intriguing. And the concept itself is interesting and important. The idea is this. Suppose you have a lot of people bidding for some object that's worth the same to everybody. And it could be, when you do this as a demonstration in the class, you fill up a jar of jelly beans or coins and say it's 10 cents for each jelly bean, and it's $100 in the jar. Now we're going to auction it off. High bidder wins the $100, but they don't know what.
They don't know it's worth $100.
All they see is a lot of coins or jelly beans. What happens? Well, the average bid is less than $100 because people are risk averse. Mm-hmm. But the winning bid is always above $100 if you have enough people, because the most optimistic forecast is likely the highest bid, and it's too high. Now, this was not discovered by psychologists in the lab. It was discovered by engineers at Atlantic Richfield, ARCO.
The energy company.
The energy company, who discovered they were bidding for oil leases in what I continue to insist on calling the Gulf of Mexico. And they realized that the leases they won had less oil than they expected. And they said, gee, we thought we had world-class geologists. What's going on? Are they dummies? And then they realized that it's quite subtle, that what you're trying to do is make a bid that will make you money if you win. And the if you win part, if there's 100 people bidding, gee, do I really want to win? Because maybe I misunderstood something, right? So that's the winner's curse. And it was found and replicated on bidding for oil leases. It's relevant in book publishing.
Mm-hmm. When they're bidding contests for books, for
yes,
mm-hmm.
Yes.
So let me see if I can clarify the way you're describing the winner's curse. So we're bidding for oil leases. We don't know exactly how much oil is going to come out of this hole or area for the next 10, 20 years. And when there's many people bidding, all of which are advised by geologists, if you make a conservative bet, the odds are you're going to lose. But if you make a bet that's high enough that you're going to win, the odds are it's not going to be a moneymaker.
Right.
Coming up, we continue our conversation with Richard Thaler and Alex Imas, discussing the book they have recently updated, The Winner's Curse, Behavioral Economics Anomalies, Then and Now. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guests this week are Richard Thaler and Alex Imas, both of the Chicago Booth School of Business at the University of Chicago. I shared with you an article I saw recently. Some real estate group did a study of tens of thousands of home transactions where there was a bidding war, and they found something very similar. The winners of the bidding war ended up paying much more than the subsequent home value was determined by looking at comparable homes in the neighborhood. So is the purpose of an auction to identify something at a fair value where it's profitable for you, or is the purpose of an auction to win at any cost?
Well, so there are two interesting aspects of that. One is, suppose you're these engineers and you've discovered this, what should you do? And if you're losing money every time you win an auction, you could not bid, but then you don't have any places to drill. And what did they decide to do? It's really clever. They decided to write a paper.
In order to get people to stop overbidding.
Yeah. Now, that's different than what the owners of Major League Baseball did.
I was going to say, why didn't they just moneyball it? Why didn't they just start looking at ugly but productive?
Well, what the Major League Baseball owners did is they colluded.
Right.
And they said, look, let's not bid anymore.
Well, the salary caps that are in all these...
No, there was just outright collusion. When baseball players first became free agents, the owners said, hey, we're losing money on these crazy auctions. Let's just not bid. And then they got slapped down.
Right.
So what can you do? You can try to... A good strategy is to bid very low on every site. Mm-hmm. And in the data, there were lots of sites that you could have gotten for $1.
Really?
And
because the consensus was there's no there.
And
were any of them productive? Did any of these dollars?
Some of them will be.
Really? So now let's bring this back to sports, because you've written papers on NFL drafts.
So the NFL draft, every year there's they have a draft for new players. The first pick is given to the team with the worst record the previous year, with the idea that that's going to be a big advantage to them and will help them improve. Cade Massey, one of my former students, he and I wrote a paper showing that the first pick is actually not the most valuable because the league has a salary. The first player gets paid the most. And you can trade the first pick for the 7th and 8th picks or for 5 second-round picks. And what we showed is if you trade the first pick for lower picks, you get more value.
So now this is known, like the Arco engineers publishing that paper, and yet there still seems to be this frenetic war for top 1, top 3, top 5 picks. Has the NFL learned any lessons from the research?
Almost nothing. They have learned that they only trade up to get the first pick to pick a quarterback. Mm-hmm. So that's smart because the quarterbacks are more valuable than any other player.
Well, of course, you want that first pick so you could get a Tom Brady.
Yeah.
Except
Tom Brady was taken with the 199th pick. And all the listeners who are football fans can have their list of people who were taken with the first pick and turned out to be busts. The Chicago Bears seem to specialize in that, although let's hope this current guy is the new one.
So how much of this, I'm seeing this through the lens of my book, which I don't want to talk about, but how much of this is just how difficult it is to predict the future, to have truly expert judgment about these very complex, very variable. So selecting quarterbacks, identifying oil leases. It seems that supposed expert advice ain't all that expert. How much of this aren't we better off just being a little more humble about our, let's give up the top pick and have 5 second round. Somebody in that 5 is likely to be half decent, right?
So let me stick to the sports for 1 second, because there's one statistic from our paper, and we've been in a process of replicating that study. So I have the new data. But here's the statistic. Take all the players at a given position, say quarterback or cornerback or running back, rank them in the order in which they're picked, and now ask the fourth guy, what's the chance he's better than the fifth guy? So for the whole thing. So what's the chance the earlier player is better than the next one?
1/2, 10/11, 5/6.
Now, if they're perfect, it'll be 100%. If they're coin flipping, it'll be 50%. What do you think it is?
I think it's less than 50%. I think it's probably
negative.
They know less than nothing.
Right, that's right. I think it's in the 30s or 40s.
No, well, they're not that bad.
All right.
I mean, because if they were, then you could just,
Flip a coin.
You'd want to, what the George Costanza, you want to do the opposite, right?
That's right.
So no, they don't have negative knowledge. They have a tiny little, it's 53%.
Okay.
So, but that's your point, really, which is they think they know this guy is the next Tom Brady, and there's only a 53% chance that he's better than the next one. And, Patrick Mahomes, Josh Allen, none of these were first picks.
Right, that's right.
Right? So
and this Mahomes kid is going to be pretty good one day.
I think he might make it.
Yeah, he's got some potential.
Right. So, and I think that is, so getting off of sports, I think that your general point is exactly right, that people are, look, overconfidence. Danny Kahneman used to say that's the mother of all biases. And we fall into these traps because we think we know more than we do. And if we had some humility, maybe if we listened to our spouses more often, because at least in my house, my wife doesn't think that I know anything. So she's always bringing me back to 50%. Right. And she's usually right.
My wife is cut from the same cloth. So I want to bring Alex back into this. So when we're thinking about the future of behavioral economics and what this means for investors or regular people making financial decisions or significant decisions, what direction are we moving in? Are we learning from all of this knowledge that's been accumulated, or are we just destined to make the same mistakes over and over again?
I don't think we're destined to do anything. I think it's a choice to read papers and look at papers on kind of published in financial journals where people are making mistakes, and then to choose to say, like, look, I actually can correct this by having a particular decision aid or asking my spouse what to do or something like that. So, what a paper you mentioned earlier, we published this actually just last year called Selling Fast and Buying Slow. And in that paper, basically, we look at institutional investors. So thinking about who in the economy are least likely to be exhibiting behavioral biases. Maybe retail traders, they're like, drinking beer in their basement while trading stocks on Robinhood. Maybe this is not the sophisticated people we want to be looking at. But, institutional investors, the average portfolio in the data set was like $600 million, $700 million or something like that. We had a data set where we actually saw every single thing they did over something like a 12 or 13 year period, as far as what they're buying and what they're selling. And what we found is because the data is so rich, we can actually construct these counterfactual portfolios. We can say, look, I see what you're buying. What if you bought something else? So it could be something else from your portfolio. You can top something up, or you can buy something new from the universe. On the other hand, we could say, look, the same thing for selling. I saw you sold Apple. I saw you sold Samsung. Let me sell something else instead. How would that perform relative to what you actually did? And what we found is that on the buying side, people actually did really well. I mean, these guys are
Not really well, but better than random.
Fund managers create some value in their stock selection when they're making purchases.
Yes, right. Yes.
But the flip side of that, not so much.
No, not so much. We really wanted to be conservative. We didn't want to, say compare them to the benchmark or something like that. We said, let's throw a dart at your portfolio and sell that instead of what you actually sold.
Instead of selling what the manager wants to sell, you would sell something else randomly from the rest of the portfolio.
Yeah, a random selling
And the
strategy.
performance difference was how significant?
Basically, same difference, but in the opposite direction.
Meaning?
So they were losing a ton of money.
So 100, 200 basis points on a random sell, better performance.
Exactly.
And the way when I read that paper and wrote about it, the way I rationalized it or tried to conceptualize it was they're bringing a very objective quantitative approach to the stock selection issue, but it seems that their cells are filled with biases and squishy decision making. Is that a fair description?
Yeah, exactly. So we found no evidence for heuristics on their buying decision. Like we couldn't find anything. Like they just seem to be very disciplined and principled about what they're buying. But on the selling side, we found literally the same biases that we found in the lab.
Has there been any evolution or improvement in this recently? That's the question that I keep coming back to. It seems that Richard, you figured a lot of these things out 25, 35 years ago. Are we any better at making unbiased decisions, or are we still subject to the same foibles?
I think you need something extra, right? You can't just say, I am not going to do this, and I have decided not to listen to my psychology. That's what it would look like to be better.
Well, choice architecture or building in some guardrails and defaults.
This is where overconfidence comes in. When you read a paper about somebody doing something silly, your first reaction is, not me. Right? That's them, that's not me.
The blind spot.
This is called the bias blind spot. Exactly. Right. So this is a well-replicated finding. When you ask people, to what extent do you exhibit a bias? I don't, obviously. I'm a smart person. But to what extent do other people? Of course. Other people are bad at selling. I'm really good. But in order to adopt choice architecture to help you out when making decisions, you actually have to have a lot of humility to say, look, these institutional investors, to say, look, looks like I'm not really doing so well on selling. I'm going to adopt some choice architecture so I don't suffer from these biases. Maybe I'll hire somebody else to help me out. Maybe I'll think longer or use the same sort of a research technology for my selling as I'm doing for my buying. And because that requires humility, which most people don't have a lot of, that's really hard to do. So I think that's why we're seeing a lot of these biases just be perpetuated forward to the point where we're, running the same analyses now as we did 30 years ago and finding the exact same thing.
So the question that, since we were talking about sports and lack of knowledge, and then you mentioned Robinhood, one of the things that's a little concerning is how some companies are putting our knowledge of biases and bad behavior to work for their own profit. So when we see the gamification of investing with Robinhood, or just the incredible rise, not just of sports books and gambling, but you could bet on every play. It's reached a point where it's ridiculous. And there is robust evidence that especially young men are having all sorts of, how can we deal with what seems to be not a good use of choice architecture, but a bad use of choice architecture, at least as far as the public is concerned?
Yeah, it's a very good question, Barry, and one to which I don't have a pat answer. I mean, it's tempting to say, look, all these sports betting apps and the gamification of investing are bad for people. On the other hand, people like doing it. They're mostly adults. And, prohibition basically didn't work.
Right.
So I think some disclosure would help. It's difficult to find out what the odds are in a lot of these things. But it's a tough question. I had a conversation on this book with Nate Silver a couple of weeks ago, and we talked a lot about sports gambling. He's a professional gambler, and he spent a year betting on NBA games and basically broke even.
Right.
So, if Nate can't make money doing this, chances are you can't. And, my advice would be, look, if you really think you like doing this, do it on a small scale.
Don't bet the house literally.
Right. And the same with weekly options or daily.
That's one of the most popular. One of our colleagues at the University of Chicago, she did an analysis of what retail traders are actually doing on Robinhood. And one of the most popular products, which because it's pushed by Robinhood, is weekly options.
And there's now end of day options where it expires.
Right.
You have till 4 o'clock to either make money or not.
So, if you want to risk 1 month's pay on that, fine.
Not every month.
Yes. Yeah. That's your lifetime budget. Right. And when it goes to zero, switch to something else.
I'm a big fan of the cowboy account where you take 3 or 4% of your portfolio. And if you want to fool around with options or whatever, knock yourself out. And if it makes money, great. But like we've seen, you mentioned Apple, if it was your whole portfolio, you would never have been able to ride it to be a 5X or a 10X.
Right.
You would have taken, I'm up $20, I'm taking the money off the table.
Yeah. So, people long ago would adopt the strategy of bringing a certain amount of money to the casino.
Right.
And then, of course, the casinos put ATMs on the floor. So it's a battle. But mental accounting, you have a gambling account.
But that's it.
So, it would be better if it were zero.
Right.
But otherwise, set it up that's something you can afford to lose. And when you've lost it all,
you're out.
Stop.
Don't go to the ATM.
That's right. So I only have you for a few more minutes. I want to ask two of my favorite questions that I want to ask each of you that I ask all of my guests, starting with what sort of advice would you give a recent college grad interested in a career in either behavioral finance or economics? Alex, you're the more recent grad. What would your advice be?
Get teched up.
Really?
Get teched up. I think that's the biggest kind of difference between even when I was in graduate school and when I'm seeing hiring pre-docs and RAs. The sort of work that you're doing in modern behavioral economics, modern finance, it just requires a different level of analysis.
So is this learning to code, or is this becoming a prompt engineer for AI?
I think you still got to learn to code. I think, I work in the applied AI group at Booth. You still got to learn to code. And a lot of this sort of modern analyses that people are doing, particularly as behavioral finance, behavioral econ has moved out of the lab into the field. These data sets are huge. Machine learning, AI tools. The type of people who are getting hired are doing sophisticated analysis.
So it's still basically STEM groups, science, technology, engineering, and math for people who don't know the acronym, but applied specifically to the field.
Yeah. And you take your economics courses, you take your finance courses, take some CS courses on the side. Those are... this is what I wished I would have done, right? When I was getting my PhD, it wasn't on my radar to take, a coding class in the CS department. People coming out now, the ones who are really successful, you have to have good ideas. That's a necessary condition. It's not a sufficient condition. You need to be teched up to a level that I don't think we were seeing back when I was graduating.
Really interesting.
And I'll reinforce that with the following. I think you need some practical experience.
Yeah.
Because the part that you don't learn in a textbook is you get this gigantic data set and it's noisy and there are errors. And so learning how to clean up a data set, you got to learn that through experience.
Really interesting. And our final question, what do you know about the world of behavioral economics today would have been useful back in the 1970s and 80s when you were getting started and in the 2000s when you were getting started?
So I think if we go back, we talked about the changes that I helped make in the retirement plans. And what I wish I had been able to accomplish more of is making retirement saving at the workplace available to the possibly 40% of American workers whose firms don't offer that option. And there were plans around, and they didn't get passed. I think the system they have in the UK is a reasonable model, which is there's a requirement that any firm with more than, I'm not sure the number, say 20 employees, has to offer a plan and automatically enroll people into the plan. And the government has like a generic plan they can use, like the government thrift program. So this is useful because big firms like Fidelity and Vanguard don't really want tiny accounts.
Right.
So make it easy for an employer. They don't have to do anything. They just have to let their employees enroll in this. And then when they change jobs, they can keep it there. Because the real problem is they go to work for a while at this firm, and they work there for a year, and they've saved $600, and then they leave and they take the cash out. So we need automatic rollover. So that's the piece of the puzzle that I don't know whether I could have done anything about, but it's what I wish we could work on now.
So related to that, what do you think of these new baby accounts? Every newborn in America next year gets $1,000, has to be invested domestically, which, we can have an argument. We were talking about home country bias, but still you're starting every infant off with a portfolio. What are your thoughts on that?
I don't know the details of how that's going to work. You could, my friend and sometime colleague when I'm in Berkeley, Ulrike Malmendier, has made a similar proposal in Germany, where she's on the German Council of Economic Advisors. I think the idea is to give kids some experience with the stock market, and I think that could be useful. I don't know how this is going to wash out, and all of these things end up being tilted toward the rich. I mean, there were big reforms made recently to the retirement plans. One of the reforms was to let you wait longer to start making withdrawals. Who do you think that helps?
People who are wealthy, healthy, and going to have a longer lifespan.
Right. So most people start taking the money out at 59 and a half, raising the date at which you have to start from 70 to 72 doesn't help anybody that's in any trouble.
Yeah, that makes a lot of sense. Alex, what do you know today about behavioral finance that you wish you knew when you were getting started?
I think when I was getting started, I wasn't really thinking about kind of being able to target these big institutional investors and thinking about getting data sets on smart money in the economy. So I think when I was starting out, I was really focused on lab experiments. I was really focused on kind of the data that was available. And if I was starting out now, I would start my PhD trying to get data sets that I eventually was able to get, because the types of, as far as like looking at my research, what has had the largest impact, what has had, people in finance, in the professional world calling me up and saying, hey, what do you think about this or that? It's been looking at the population that people are actually interested in, which are, the smart money in the economy. So I think, and this is, I think, you have this analogy of looking under the under the street light. Where is a lot of behavioral finance
for the missing car keys?
Yeah, exactly.
That jumped on the street light.
Where are you looking? Oh, it's where the data sets already are. So Terry O'Dean had this genius idea in '98 when he published his paper. What did he do? he made that data set available. Now it's easy to just, I got an idea. Why don't I look at Terry's data set? Terry's data set is great, but it's 3 years in the 90s with, a couple hundred retail traders. And that tells you about that specific population, but you can't have a field evolve looking at 3 years of retail traders with $10,000 portfolios. So I think if I was going into the field now and thinking about, what have I learned? It's the power of getting data sets and running analyses on populations that are important for the economy and for finance.
Really, really fascinating. Gentlemen, thank you so much for doing this. We have been speaking with Richard Thaler and Alex Imas, both of the Booth School of Business, about their updated version of The Winner's Curse. Strong recommendation. If you enjoy this conversation, well, check out any of the 592 we've done over the past 12 years. You can find those at iTunes, Spotify, Bloomberg, YouTube, wherever you get your favorite podcasts. And be sure to check out my new book, How Not to Invest, The Ideas, Numbers, and Behavior That Destroys Wealth and How to Avoid Them. I would be remiss if I didn't thank the crack team that helps put these conversations together each week. Alexis Noriega is my video producer. Sean Russo is my researcher. Anna Luke is my producer. Sage Bauman is the head of podcasts here at Bloomberg. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.